Well, that rates decision coming as a surprise to the market, a cutting to 6.75%. Let's look at this picture. I mean, the policy aims to stimulate the supply of credit to support economic growth moving forward. But as we've discussed so many times before on this show, I mean, we haven't really seen Kenyan banks follow in tandem with the lowering of the central bank's rates. They've kept their lending rates pretty steady. So just how effective a policy stance is this in your books?
Thank you, Alishia. As you point out, banks have pretty much maintained their lending rates for a very long time at very high interest rates. So I would agree with you that the intervention by the central bank doesn't seem on its own to be the key to a reduction in lending rates by the commercial banks, but it is nevertheless a very powerful indicator of what message the government is trying to send out. When you're talking about stimulus initiatives of this kind, normally the challenge is when to put in the effort and when to cut it off. And I think by the bank continuing to lower rates, what they are saying is even as we see a resurgence in the economy, we are not out of the woods and we still need to continue to stimulate what is still essentially a weak economy. But I agree completely that banks are unlikely to follow suit on that indicator alone.
Well, so where we've heard commentary out of some analysts saying that this latest move has been a bit premature and is pushing banks too hard, too fast, you're obviously in disagreement with that kind of sentiment.
I think we just need to look a bit wider and ask ourselves why it is our banks have been able to maintain what are artificially high interest rates and still do what appears to be quite good business. I think it calls for an opening up. And much as we have 40 banks, we have said before there's a need to consolidate them and attune the competitive forces between banks, because they tend to move as a group in their rates, and that really hasn't served our economy very well. I think you need to look for other factors that would incentivize banks to have a more competitive interest rate structure.
On that note, let's put banks under the spotlight today. I mean, banking stocks at one-year highs have been placed on a hold watch list by some market analysts, a signal to investors that buying the shares now may not yield capital returns in the short term. Do you share the sentiment, especially after the slew of earnings reports we've seen hit the markets?
I think I would agree with that. I think if you look at one of the most famous banking stocks in our market, Equity Bank, their growth seems to have slowed down quite significantly. And I think as a test case for what's happening in other banks, you will see that growth appears to have petered off a little bit. And I would agree that at this point in time, investors getting in would expect much more subdued returns. And as a result, you would expect them to look at other counters that perhaps are appreciating more rapidly and would give them a better return.
If we look at Equity Bank, there some commentary has said that a high return on assets at 7.6% coupled with capacity for growth position equity well to actually deliver on above sector earnings growth moving forward. But it's a higher loan book risk, lower end retail market focus, and then increased competition from your microfinanciers as well puts that earnings growth at risk. I mean, how are you weighing the merits and demerits of this company at the moment?
I would agree with everything you said. I would add one particular caution. People talk about a 7-year threshold in banks, and the equity is just about getting to that point where its loan book would come into acute focus. And people say, given their lending model, it'll now be tested over the next year or two to see how much of that loan book remains performing and how much of it becomes unperforming. And I think there's a lot of expectation that will they be able to go through that test, because about every 7 years, they say, for a bank that's just coming into a particular sector, its loan book gets tested. And there is some talk about their loan book perhaps turning a little more to the NPL than has been the case previously.
So keeping an eye on that when it comes to equity. Africa Alliance, in their recommendations in the meantime, only has KCB on a buy recommendation. What's your view on that counter at the moment?
I think KCB really stands out. Their regional expansion is just about to begin to contribute in a very big way to their performance. And in the results we saw, I think other than perhaps Standard Chartered that has a very conservative approach to the market, KCB does hold out a lot of promise in terms of their regional aspirations and the fact that they really now would stand as one of the largest banking institutions within this region and certainly within Kenya. And looking at their price and other factors that one would bear in mind, KCB really is the most attractive counter in our banking stocks by some accounts.
Of course, KCB in the spotlight, specifically when it comes to its regional expansion drive. We know that it's aggressively entrenched its footprint over in Sudan as well. That opposed to the likes of a player, like you said, like Standard Chartered, that has adopted a more conservative approach through this. I mean, what do you see Standard Chartered's approach being moving forward, given the fact that we've got other players in the market like KCB, like Equity Bank, working on their African footprint more aggressively?
I think you will find Standard Chartered will keep to their model for the moment, because the one thing it did do was it did give them the most impressive rise in profits over the period under review. They rose by about 40%, and really no other bank was able to match them. And they're attributing that to the efficiency, cost controls internally. So certainly I think in the short term, you'd expect Standard Chartered to keep to that particular business model. But certainly in the future, once they've consolidated their current growth and potential, I would only expect they would have to look at regional expansion for new growth.